In this video, we will do a brief overview of financial institutions. In a world without financial institutions, for cash and securities and equity loans to flow between net savers, the households, the general public, and the corporations, it would be a difficult process. Generally speaking, a business needs to get money from investors and borrow money to get started. Once they get started, they hire people. They employ those people and pay them a salary. And that's how the cash flows around the cycle. People in the households work in those companies, and then they use their money when they have surplus savings to invest or lend to those companies. However, if there were no banks in between, corporations will have a hard time reaching the general public, offering their equity and asking to borrow money. Also, individuals will be a little more skeptical if there wasn't somebody monitoring these corporations and what they do with their money. So in a world without financial institution, this flow of money and equity will be difficult to accomplish. So financial institutions, banks, for example, investment banks, the stock exchanges, they help ease that transaction and that security. So as you see here on the slide, the average household saver may view direct investment in corporate securities as unattractive because of monitoring costs. If you invest in a company and there's nobody in between to keep an eye on the companies and report on how the companies are performing, it's going to be hard for you to keep monitoring on a company if you don't work there, if you're just trying to invest to buy some stocks. Also, if we go in the previous scenario where companies have to go almost door by door, one by one, to get money from investors, the cost of getting investment money and borrowing money will be very, very high. But when you have a central place that can help bring these things together, it becomes a lot cheaper to be able to help with these transactions. And other issues like liquidity costs. If you buy stock in a company and you need to sell it, instead of you finding another buyer out there as an individual, the brokerage firm, the stock exchange, and all these other places facilitate these transactions between buyers and sellers. This is one way to look at a modified version of this with the financial institutions in between. It's an oversimplified or incomplete, but it's just letting you know that then you put these brokers and these banks in between, and it helps circulate those funds. Now corporations don't have to go to millions of households. They can just go to these firms where those millions of households are already doing business there. And because they're handling all these corporations and households, those cost of transactions become very low. Plus, these people here help monitor these people here, the corporations, so they can get information and make better investment decisions. And that's just one or two examples of all the things that happen in between and why we need the financial sector. Just a little vocabulary here. Now, we're going to talk about here primary securities and secondary securities, not to be confused with the primary market and the secondary market. Primary market and secondary market, that just deals with who's buying and selling those securities. Here, it's somewhat of a transformation. If we go back to a slide where it says asset transformers, there's many ways this happens, but the easy example is banks may take deposits from either businesses or individuals, and then they use those bank deposits, like your checking accounts and saving accounts. They use that money then to create loans. So they're transforming the asset, the cash that the people deposit, and then they use that cash to create loans. And that's just one example out of many ways in which they can transform one asset to another and facilitate that exchange of money. So primary security and secondary securities is talking about that a little bit in a way. Financial institutions purchase financial claims issued by corporations. They get equities, bonds, and other debt claims. And then the way they then what they sell to the general public, or they transform, I guess, the secondary securities is what they call those, because they're backed by primary securities. Secondary securities are often more attractive to household savers. So these people may want loans, insurance policies, and stuff like that. And that's what they want. They don't necessarily always want to hold a bond or a stock. So that's another way they provide a better flow of assets between the households and corporations. So more on specialness and regulation. Okay, so regulation is big in the financial sector. So financial institutions receive special regulatory attention. And by special, we're not saying better or worse or more or less. It's just a specific type of attention. Negative externalities of financial institution failure. This one's highly bolded like that. So the 2008 financial crisis, for example. So a lot of the typical complaint is, why are we bailing the banks out? The problem is now how you bail them out. Sure, that can be argued, but the problem is that if they don't help them sometimes, if the big banks fail, it creates a lot of problems in other places in the economy. So it's not that easy to let them go away, because then you may cause a bigger problem. Special services provided by the financial institutions. We spoke about those a little bit. And because of those special services is why they get special regulations. Institution-specific functions such as money supply, transmission, credit allocation, payment services, etc. In other words, well, all the things that you know that banks do and more. Net regulatory burden is the difference between the private cost of regulation and the private benefits for the producers of financial services. One way to look at what that sentence is trying to say is that if you have too much regulation, or way strict and very invasive and very constraining, then the financial institutions are less likely to even go into business and provide these services. So there still has to be a benefit. You're not going to go into business when it costs you more to stay in business than what you can make. It has to be worth it. So there's a balancing act where you don't want to neglect the public, but at the same time, there has to be a net benefit for the businesses. So that's always an issue to be careful with on how to regulate the financial institutions. Specialness and regulation continued. Types of regulation. Now, these are just some of them. There's plenty, and trust me, there's a lot more. Types of regulation that seek to enhance the net social welfare benefit of financial intermediary services. Now, notice a key point here is social welfare. The idea is to protect the economy and society as a whole from abuses of financial institutions. And because at the end of the day, it's money, and money is a delicate thing. So safety and soundness of regulation. So you can't just throw any regulation out there. It has to be sound, something that it's actually helping society without putting unnecessary burden on the institutions. We have monetary policy regulation, credit allocation regulation. We'll talk more in detail on these in other sections, but these are just some of the key ones, or the ones worth highlighting. Consumer protection regulation, that's a big one. Investor protection regulation, entry and charting regulation. Okay, investor protection regulation is a little different than consumer protection regulation. Uh, there might be some overlap, but investor, it's really strictly related on people investing in businesses, whether buying stocks, bonds, etc. Versus consumer protection. Let's say if you borrow money from a bank, credit cards, all kinds of things like that, like the bank services you get. There are differences, key, very, very big differences. Entry and charting regulation, what they're talking about there is if you choose to open a bank, what are the regulations for you to enter and get registered and chartered and all that good stuff. Protect against the risk of financial institution failure. So regulations also include on how their balance sheet has to look like, to put it that way. If they are not diversifying their assets, then the risk of that institution starts going up. So they have to have a variety of assets in order to lower the risk of failure. No more than 15% of equity to single borrower. So this is just like a direct example, just one, that let's say you have a bank and you have $5 billion worth of assets. Well, you cannot lend more than 15% to only one person, because if you put all your assets to one borrower, that is a very high risk maneuver. So that's one way to diversify your assets. A bank lending money, they have to spread their money across many loans to different people. Minimal capital requirements. You got to have some capital to back up your positions. Guarantee funds. Now, these are regulations, but really comes from well, the banks have to deposit also here. It comes to the cost at the financial institutions as well, but they're talking about like the FDIC. You probably have heard that your money in a bank account and a checking account, it's guaranteed up to a certain amount of money. I believe it's like $250,000 now. That number does change from time to time, and sometimes it changes to a very high number in times of emergency. But this comes from regulation. This is not because the banks are nice to you and they say, I'm going to guarantee your money. Here we have monitoring and surveillance. Involves on-site examinations and review of accounting statements. There is a department or a branch or an agency in the federal government, and their job is to go visit banks and inspect them. They inspect the banks, and they look at their statements to make sure everything is according to regulation. The FDIC monitors and regulates DIF participants. So the FDIC, this is directly related to those that insurance on the deposits. Increased regulatory scrutiny following crisis. So every time something bad happens, because the banks are messing up, you'll see a huge spike on heavy regulations and then a lot of monitoring. And then it kind of eases a little bit, and then it happens again, and it keeps it on a cycle. Regulation is not costless. Back to what we mentioned earlier, you want to make sure that you don't overregulate, and then these financial institutions become useless and they start shutting down and getting out of business. And you need them. You need the financial sector in the economy in order to ease transactions. If not, the economy starts slowing down and contracting. We have other things like monetary policy regulation. This is also dealing with the Fed and monetary policy. Banks have a role in transmitting monetary policy from the Federal Reserve to the rest of the economy. One quick example before we get into the bullets: the Fed may dictate what they call their required reserve, meaning that if banks have $1 million in deposits and their required reserve is 10%, that means they can lend out $900,000 and the other 100,000 has to stay in the bank. If they increase that percentage, that means that the amount they can lend out or use for loans starts going down. So that actually has an effect on the money supply on the economy. So that's what they mean, that they actually transmitting the policy. As in the Fed sets the policy, but the banks are the ones that actually transmit this and make it. This is where it actually becomes real. So Federal Reserve directly controls outside money, such as notes and coins. Bulk of money supply is inside money, deposits, may be required to maintain a specific level of cash reserves against deposits. So these last two bullets are more related to the example I was given. Credit allocation regulation supports socially important sectors, such as housing and farming. So requirements for minimum amounts of assets in one particular sector or maximum interest rates or fees to subsidize certain sectors. Let's talk about that maximum interest rate, subsidize certain sectors, let's say farming. If we want to keep our farmers going, they may get regulation may allow them to borrow money at lower interest rates, or at least at a cap where no more than, and it helps them with their cash flows and continue to stay in business. Now, minimum of assets on a particular sector, that could be a company that gives out credit. They need to have a minimum amount of assets to back up those credits. But in many ways, the point is that regulation can then put ceilings and floors to certain institutions on what they can and cannot do. Here are a couple of sub-bullets like qualified thrift lender, 65% of assets in residential mortgages. That's an example of a minimum amount of assets. Usury laws and regulation. The usury laws, for those who are not familiar, this goes by state mainly. There are some federal caps, but the states pretty much have their own, each state has their own percentages. And what it is the maximum interest you can charge depending on the type of business you're in. It varies. Like pawn shops are allowed a much higher number than, let's say, a bank on their lending practices. Some more in the consumer protection regulation. Also, to prevent discrimination in lending, things like Community Reinvestment Act and the Home Mortgage Disclosure Act. If you're interested in an example of discrimination in lending, you can Google real estate redlining. And there was a time, and it still gets monitored because from time to time, some experience, but there was a time it was very rampant that banks wouldn't give mortgages to certain people if they were trying to buy within a certain area. So, and that's how they were controlling who could buy where. So that we have regulation to prevent that. Also, business loans, that's just one example, the real estate one, but also business loans and any kind of other type of loans that they get monitored to make sure that there's no bias in their process, or they're not displaying any bias when they look at who gets loans and who doesn't. Effect on net regulatory burden. Going back to the net regulatory burden, meaning you can't overregulate because then it becomes a problem. It's not worth it to stay in business. So the FFIEC processed info on as many as 13.6 million mortgage transactions in 2020. Analysts questioning the net benefit. So the thing is, this one, I'm not gonna say catch 22, but the point of questioning the net benefit, they're saying like, well, when they look at all these, if they look at all these mortgage transactions in just 1 year to see if there's any discrimination, and then they're not quite they're not seeing it, then they go like, well, it's not worth it. It's no benefit. Why are we putting all that effort and all this monitoring? But then you have the other side. If you don't monitor, are they going to fall out of place? So there's the question like, well, maybe the monitoring is what's keeping them in check versus don't monitor them. And then also it goes like that. I guess an analogy would be sometimes a police car just parks on the side of the highway and never pulls nobody over. But what it's doing is just by being there, people slow down. So just by monitoring might be the thing that is preventing it from happening. Here, we're going to talk a little bit about investor protection regulation aimed at protecting investors that use investment banks directly or indirectly. Protection against abuses such as insider trading. So that will be like one of the big ones. Let's say you have your app or you're online and you have your own brokerage account and you are, you're doing some investments and you're just doing everything right. But then you have people that do insider trading and then you get affected, believe it, whether you were directly involved or not, or with that company, you get affected because other people are taking advantage of information that is illegal to use to invest. So that's one way where you're being protected as a general, the general public is being protected as investors by not allowing other people to cheat in the system. Things like lack of disclosure, malfeasance, breach of fiduciary responsibilities. Here, this is more like if you use a financial advisor, for example, or a wealth manager, that if they don't follow certain rules in order to better serve you instead of what better serves them, then they will be in violation of these regulations. Here are some key legislations that got to do with it. This is just 3 examples, 3 of the big ones, but there are plenty more. You got the Securities Acts of 1933 and 34. That's kind of like where it all started. If you notice, that's just a few years after the depression, the 1928 crash or 29. Oh, I forgot the year. So a couple of years later, they went ahead and did put a lot of laws in place to prevent that from happening again. Investment Company Act of 1940. Again, kind of follow-ups on these. And then we had a Wall Street Reform and Consumer Protection Act of 2010, of course, right after the recession. It goes back to one of the slides we had earlier, where it mentioned that whenever there's a crisis, regulation goes up. Here's an example. The Great Depression and the Great Recession. Enterprise risk management. Okay, so recognize the value in prioritizing and managing the impact of risk on an interrelated portfolio basis. This is not new, but more recent. And what was happening was that organizations were evaluating their risk by department or processes, systems, but they were not evaluating the risk as a whole. And that's where the interrelated portfolio basis comes in. So recent financial crisis led to the focus on enterprise risk management. So it's saying like, well, the individual pieces may look low risk, but when you look at everything as a whole and the way they're intertwined, there could be a high risk situation going on. Like it says there, prior to the crisis, the focus was on process and systems. After the crisis, attention shifted to building a strong risk culture that is supported by government arrangements. So a more holistic view of an organization or an enterprise and not just processes, systems, individual business units, departments, etc. Finally, we're going to talk about fintech. This is our final piece to introduce in this video. This is, of course, probably the newest thing in finance, with the internet coming on and then all the new technology that keeps on coming up. Fintech is becoming more and more popular, especially now with cryptocurrency and blockchain. So financial technology, or fintech, refers to the use of technology to deliver financial solutions in a manner that competes with traditional financial methods. Before, you had to deal with a broker, you had to get on the phone or an email or whatever the case may be. Now you can get online and open an account and do everything yourself without ever talking to anyone. That's one example. Now, the more popular one, which is also included in financial technology, things like cryptocurrency, blockchain, etc. But it's not just blockchain and cryptocurrency. It's pretty much any financial service that is being enhanced by the use of technology. And that's it for this video. See you on the next one.